Okay, again, agenda point 1, 2, 3. The fourth one, we're going to go over some credit information, what you may or may not know about credit, and maybe some tips and tricks that I can help you with for building your credit. Also, estimated payments and funds for a mortgage, give you some examples based off of the programs that I'll be sharing with you for first-time home buyers, and also review a high level of the mortgage process steps. And then at the very end, my contact information to get a hold of me. Next slide, please. Mortgage One has been in business since 1994, and the CEO of the company is Mark Warkins. It is a personally owned company. We now have over 37 branches in over 5 states, over 200 licensed loan officers across those 5 states. We are the leader in the Miciuda first-time home buyer program. We have been the leader for over 8 years now. Mortgage One does pride themselves on being fast, friendly, and honest, and we are the lender buyers trust the most. Next slide, please. A little bit about myself. A couple of you on the call may be in this picture, actually. But my name is Karen Miciuda. Once again, my husband is John Miciuda to the right. Been married for 15 years. Our dog Luke is our one and only. And the picture on the left is my whole immediate family with my sibling sister Kim. She has 3 children, Gage, Kaylin, and Grace. And my other family, soon to be hopefully one day, my sister's boyfriend and her 3 children are in this picture as well, along with a couple of boyfriends. But my husband and I both love to golf. We love watching sports and just very passionate about hanging out with our family and friends. Next slide, please. Why are you here? Kathleen asked me to do this, indicated that I was very interested, and we just wanted to hear from you all too. Why are you here? Was it that you just aren't sure where to start, who to call, rumors about the industry, the purchase prices, what programs exist for first-time home buyers, what you qualify for, etc.? Next slide. Okay, so I wanted to start off with building your credit. Main reason is credit definitely is an important factor in the home buying process. The knowledge of your own credit score, how your credit is even calculated, is very, very important when preparing to buy a home and to get qualified for a mortgage. How many of you out there even have an idea what your credit score is? Do you understand how your score is even, created? What determines all of that? So I wanted to walk through those. Yes, Michael. Oh, just raising his hand. Okay.
Sorry,
yes, thank you. Thank you for participating. Nope, you're good. You're good. Thank you. Okay, so credit score, building your credit. Knowledge is power. To understand your credit score and how it is calculated is very important. I work with a lot of first-time home buyers in this phase, as you all are, on going through your credit report. I can indicate easily for you, based on your credit score, what programs you qualify for, and or what you may do to your credit to get it to that credit score if you're not in the predicament at the current moment to purchase. But checking your credit reports is very, very important. There is a link at the bottom, which when I send out the presentation as well, Experian is one of the very helpful credit bureaus that can help boost your credit score for free. It is a legit app. It is a confidential app. You do not have to pay for anything. I've been through it myself to test it. I've worked with a lot of clients to go through it. It is truly an app that I've utilized with helping people build their credit, fix their credit, but it's a very, very good opportunity for everyone to utilize. And that's a whole nother subject, a whole nother walkthrough. But if you don't have it, you can download the Experian app in your app store, and they'll pull the report. It doesn't impact your score. It just shows you what it is based on your personal information. And then it also gives you ideas of how to improve it. One of the interesting, I think, aspects of the app is that I had a client who actually came to me with no credit score at all. He truly just didn't have credit cards, never used credit, but he's a first-time home buyer and really, really wanted to purchase a home. So I had him log into the Experian Boost, and what they did is you can connect to your bank account, so it could download 6 months of a bank statements automatically. You don't have to do anything but log in. Again, it's a secure application. I've been using it for many, many years, and a lot of my colleagues do as well. But you put in those bank statements, and the app itself literally picks out if you're paying for a cell phone or you currently rent and your utilities come directly out of your account, that pulls it onto your report automatically. And as long as you have 6 to 12 months payments that you've been making to those, like cell phone bills, car insurance, anything of that nature, and that automatically generates a score based off of that. So you can go from having no credit score to possibly getting up to 700 in a matter of minutes with uploading your bank statements. So it truly is, and I have lived in the program. I have, clients that have been in the program. It's a really, really great, unique tool to utilize. So if you haven't started or don't know your score, I would definitely start with that. Basically, as a lender, we look at, your credit is pretty much the number one aspect of a mortgage approval. So monitoring your score from now forward is very, very important. If you may or may not know, but the payment history counts for 35% of your credit score. So that's the highest factor that goes into your credit score. What does that mean? It means make your payments on time, period. Do not have any payments made over 30 days late. That's automatically a delinquent on your account, and that sticks around quite some time and can impact your score pretty dramatically. So if you have, again, a car payment, a Cabela's card, Victoria's Secret card, it doesn't matter, pay your payments on time. That will naturally grow your score. But once you do make a payment late over 30 days, it will definitely downgrade your score quite a bit because it goes towards 35% of your score. The next tier that that contributes to your score, 30%, is the amount owed. So say you have, for example, you have a credit card that has a limit of $1,000, but you owe $1,000. That's not good. It looks like to the bureaus that you're basically overusing. You're always maxed out. A good percentage to go for is 70% of that $1,000 limit. So you want to keep your minimum your balance basically around 700. That allows you them to calculate that it looks like you make your payments, you're trying to pay off the card, and you're not just maxed out all the time. So, but that goes towards, if you have, a couple cards and they're constantly at the limit or near the limit, it will put a ding on your score. And a lot of these things are temporarily done. So keep in mind credit bureaus pull your credit, or your credit is reported on a monthly basis, but it can change daily based on when that specific Victoria's Secret or Cabela's or your car loan report to the agency. So all day long, every day, 365 days of the year, your score can change on a dime for most of these things. So it's important, again, to know your score and how it is impacted for monitoring it. The third item is the length of your credit history. That counts for 15%. So say, for example, you just open a credit card. You will have a ding towards your score of about 15% lower, give or take, because you just opened something. Not that it's a bad thing that you opened it. It's just the length of time. The bureaus reporting like to see an established amount of time of 6 months to 12 months, especially, that you've been utilizing and you're already into having, say, that new car payment. It is just temporary, again, temporary negative, if you will, but it will be reestablished as the months go on and the payments are made. Any new types of credit used, again, that counts for about 10%. If there's a ton of new credit, you just went in and you opened 5 different credit cards, which, God forbid, nobody should really be doing that. But if for some reason you did, if you're trying to pay something off and pay it with another one, that counts towards 10% of your actual credit score as well. So some of those items, just to let you know, what contribute to your score. The next column, going to pay off delinquent accounts. as I mentioned, payment history is 35%. So if you have anything delinquent or anything that was past due, there's a charge off, a collection, a judgment on your credit report, pay it off. And mostly for a mortgage, if you can get that paid off, if you can afford to do it prior to getting into the mortgage pre-approval process, that is preferred. Not always is it mandatory that you pay it off, but to help your score and help to get on better programs, better interest rates, it would be much, much better if you paid any delinquent accounts off. So basically what that says, it's resulting in a responsible borrower. So if you're not making the payments and you just left the judgment out there, you left a collection out there, that kind of just looks to us like you don't care about making your payments on time, or you don't care about that credit card at all. We want to know that you're responsible to make payments. Again, kind of spinning off that too, making payments on time is thoroughly important. Delinquencies can remain on your credit report for up to 7 years. Bankruptcies do linger on the reports for 7 years plus. And inquiries is a big item. People always say, oh, I don't want anybody to pull my credit. I don't want anybody to pull my credit, because it does impact your score. And it does. It does initially, but it eventually goes away. It's on your report for 2 years that you have an inquiry, but it doesn't ding your score per se for 2 years. It's just an inquiry on your report. And we'll get to this in a little bit, but there's also a difference between pulling what's called a soft credit report or a hard credit report. And I'll walk you through that as well. So building good credit does take time. You know, again, if you know your score, you don't believe it's where it needs to be, the average credit score based on Experian data is 715. So if you're around that, you are good to go today. If you're below that, I'm not saying you can't get a mortgage loan. There are programs that go as low as 580 of a credit score, but the national average for a credit score is 715, just to give you a guide for that. Next screen, please. I've included this in my deck that is the 3 major credit bureaus. So you have Experian, TransUnion, and Equifax. So if you're not aware, these 3 are what I pull in as a mortgage lender. Your hard credit report pulls from all 3 of these bureaus. So even if you're on the Experian app, that is just one score that's generated. Each bureau generates their own score in a different way. Why? I think it's the most silliest thing, to be completely honest, but it is what has existed for many of years. And this is just for your information. Again, it'll be in the deck, it'll be in the recording, you can have access. You can also go online to each of these bureaus and get some of your credit score information as well. But I found the Experian app seems to be the most up-to-date and most reliable of all. These are also the addresses that you can send any disputes into. So if you want to dispute an account, this is the actual bureau. You can mail them stuff, you can call them, you'll get a fax number eventually, you can email stuff to them. But just to put this in here as a helpful slide for you guys. Next slide, please. I know it's a lot of information. Can we stop here and just raise hands or questions for anybody that might have them before we get started on the mortgage approval process? Brendan, thanks for raising your hand. Do you have a question as well?
Yeah. Hi, Karen. I have the Credit Karma app, and I check that pretty much daily. What's the difference between that app and Experian?
That's a great question. And I think because Credit Karma advertises a lot, to be completely honest, people tend to go towards that app. Credit Karma, from what I know, and again, this is just my my evaluation and my kind of looking into each of these apps on my own, that it's not, the Credit Karma is not as up to date as one directly with the bureau. So Experian is one of the bureaus, so it is updated more timely and more effectively from what I understand. I do not have the Credit Karma app myself, but I do know a lot of my clients have used it, and at least it gives you a good gauge. So I'm not saying it's not usable or user friendly or anything like that, continue to use it. But the Experian one is also free. You might see a difference in your score even a tad, because Credit Karma is not the bureau directly. They say they're pulling from all of them, but going directly to the actual bureau is important.
Sorry. So this might be a silly question, but so if I got the Experian app, would that affect my credit score, or would that's not even
Nope,
part of it?
it
Okay.
would not, it's not a silly question. It would not affect your credit score at all, and it will not affect anything. It's just another app like Credit Karma, but it's basically directly from the credit bureaus, if that makes sense.
Okay. Thank you.
You're welcome. Thank you. Anybody else with questions? Okay, we'll go ahead and get started. So this is now, I'm moving from credit. There is a difference out there, what's called a pre-qualification and a pre-approval. So I thought just to maybe do some clarification, a lot of, buzzwords out there in the industry, but a quick pre-qualification is basically a quick process. It's say on the phone today, someone were to tell me, okay, I make X amount per hour. I've been on my job for 2 years. I have $5,000 in the bank. My credit score is 700. What do you got for me? So it's a kind of a verbal, quick process indicating what you would qualify for. Totally different, totally quick, totally not what you should be doing if you're ready today to go look for a home with an actual realtor. So just getting a verbal pre-qualification is, to me, just again, it's just that. It's just a quick verbal conversation. You could then also send me your pay stub, say a week later, which does happen. And instead of making $20 an hour, I get somebody's pay stub and it might say it's $12 an hour. So the whole thing changes when the facts come in. So, and that's what is a deeper dive into the pre-approval. So it's a more thorough process. I run your credit. I see visually your pay stubs, your W-2s, bank statements. So I'm committed and you're committed to this process. And majority of the realtors that are out there today, especially the ones that I work with, will not start taking you to homes to go look at them until they have a physical pre-approval letter from myself or from another lender. It's just something that needs to be done. It's protection from them. It's a waste of your time. It's a waste of their time if you don't go through a true pre-approval process. That is highly recommended. I'm not sure, again, if you know that, have heard both words, but a pre-approval is what you should be looking to get if you are ready today and ready to get out there with a realtor to go look. What is offered is basically for any pre-approval, myself personally can do a free credit report for you. You don't have to pay me to run that information. And then what I would do initially is pull what's called that soft credit report. And basically what that is, why that is done is because there was a law passed that if I went straight forward to pull your hard credit report without doing a soft pull and not opting you out of trigger leads, may sound complicated, but basically there was a law passed that anytime someone's hard credit report is pulled, absolute chaos takes place and you will receive hundreds of solicitation calls, texts, and emails from other lenders, banks, people, because your information was just given up to that solicitation. So there's this opt-out screen that I personally do for you. It's based on your personal information. So we pull the soft report. I can review that with you, but I also log into the opt-out website, simple website. You can do it, but I typically do it for all my clients so I know that it was done and done timely. And then from there, 5 to 7 business days, I can then pull that full credit report. Doing all of this just helps me help you not get hundreds of phone calls of solicitation. It sounds crazy. I don't know why it was ever passed before. I don't know why. We're all fighting very hardly to get that removed. It has gone pretty far up actually to the Senate right now. And I'm hoping that happens, for next year. But anyways, it's just a process, but just to give you all an indication. So if you are talking to anybody else and someone does just pull a full-blown credit report from you, you will get, and it's happened before, people made mistakes and they've just said, yes, go ahead, pull my credit. And they said on average, they counted about 100 between texts and phone calls, at least 100. So I help you with that and avoid all of that. But that's kind of the initial stages of getting the pre-approval together. And then the documents that are required for me to do an evaluation are, like I mentioned, a month worth of your pay stubs, 2 years W-2s. If you're W-2, if you're self-employed, it's a different story. I can talk to you individually about that. And then 2 months worth of your bank statements and just a copy of your front and back of your driver's license. Those are the documents required for me to initiate and review how much you're approved for, what type of program you're approved on, the interest rate, the payments, your debt ratio, and all those things we'll go over in the next slide. But those are the documents, and that is what is needed for me to initiate that process with all of you. Next slide, please. So this chart here basically runs through different first-time homebuyer programs that exist today that I am licensed to do all of these. Mortgage One is licensed to do all these programs. If you are not familiar with, if you've ever heard the terminology Fannie and Freddie Mac, they are the government investors. They're mortgage-backed company, or mortgage-backed. They're the ones that basically buy and invest in all of these mortgage loans. So they have some of their own specific programs. So the top one being Fannie 97. It's Fannie Mae specifically. There's others that are Freddie Mac specifically. There are some that are just government directed funded, which is VA loans, FHA loans, Miciuda loans. And most of these, I'll go down individually, but does anybody have any questions on before I start, the pre-approval process? Sorry, I flipped to that slide pretty quick. Okay, so I will continue on here. So as you can see in the first column, minimum credit score. As we spoke about earlier, the average score nationally is 717, or 715, sorry. So that's a great score. As you can see, programs for first-time home buyers can go as low as 580 for a credit score, and as a minimum of 580 up to 660, depending on the type of home. So majority of them, I would say on average, you would need a 620 for a first-time home buyer in order to be qualified for any of the first-time specific home buyer programs that are listed here. So if you got that score, that's the first thing. The next thing, moving over to the down payment. Most programs for first-time home buyers usually end up around 3% down payment. It can go down to 0% if it's a VA loan or a rural housing loan. And I'm not going to go into full detail of each one of these loans, but just to give you a high level, this is something that we can discuss later on when we're talking through your pre-approval on each specific program. And the income limits, some of them, these programs, I just wanted to point that out, some of them are restricted to income. So if you make too much money, some of the programs are saying, no, you don't really qualify for first time because you're already making X amount of money. So if it says none, they don't have any limits. You can make as much as you are, and there's no restrictions. 80% of area median income. What that basically means is for each county, there is a specific median income for Oakland, Macomb, St. Clair County, and as long as you're at 80% of that income or below, which its average is around 115,000, and if you're below that, you would be fine to qualify for these loans. Some of them have those restrictions, some of them don't. Price limits. Majority of them for a purchase price don't have a limit, but the one in specifically that does is the Miciuda program in the middle there. That is the Michigan State Housing Development Authority Down Payment Assistance Program. It is my #1 seller for first-time home buyers, primarily because it gives you more flexibility of how you come up with your down payment. And the state of Michigan doesn't give you, but they loan you, so to speak, $10,000 towards your down payment and cost. So right off the bat, if you qualify for a Miciuda program, you have the credit score of 640, it's around a 3% down payment program. You're in the income limits. However, they have a purchase price limit of $224,500. So for majority first-time home buyers, that should be where you're at today. However, as most of you may know, the market today and has been pretty out of control with prices. So some of you may be able to find a home in that range or below that suits your needs. Others would say, no, I just really want that $240,000. If that's the home of your dreams, that's the one you want, you would not be able to go under the Miciuda and get the $10,000. So that's the only caveat. And then again, the $10,000 that you're getting from the state, it is the government. So let's all just agree to disagree. Nothing's for free. So that does have to be paid back when you purchase, when you sell or refinance. But it gets you into that home. And I'll show you on the next couple screens. The difference of that is why it's utilized the most. It is because of that $10,000. Most of you starting off, maybe you do have, $10,000 saved, but now you have 10 more to utilize to help towards your down payment, closing costs, and it helps tremendously with the total end monies that you need to bring to the closing table. The other important factor with qualifying for any of these programs, and any program, not even just first-time homebuyer programs, is your debt-to-income ratio. So what that is your minimum monthly payments that show on your credit report. So that credit card or that car payment. So say you have a $300 car payment. You have a credit card that the minimum required monthly, not what you pay, but the minimum required is $25. You have $325 of debt against you at this point to qualify, plus the new proposed mortgage payment. Add those up and you divide by your gross monthly income. That is what your debt ratio is. And as if you can see on here, some of them programs are flexible, meaning per findings of what we see in our system. Miciuda, once again, is very strict. They do not want to go over 45%. So if you are already maxed out, let's say, at a $224 purchase price with your current debt, the 3% down, and you're at 48%, either we can't do the Miciuda or I have to work with you to figure out how can we get that ratio lower. Basically, as you can see, the majority of it is maybe paying off that credit card to not have a $25 payment, if that helps move the needle for that debt ratio. And then the other programs a little bit below there, the rural housing program is maxed out at 41%. So they're even a little bit more strict when it comes to your debt ratio. So these are the main programs that I can help you get qualified under, depending on where you're at with your credit, income, assets, everything. Does anybody have any questions? This was very high level, but again, just wanted to give you an idea of how many first-time home buying programs do exist today. These are probably the top ones as well. There are some others that are based on different cities. The city of Detroit has their own grant program. Different parts of the country have their own grants, but these specifically are geared towards the first-time home buyers. And I would like to stop here again to see anybody have any questions. Is this too much information, not enough information, overwhelming? Please do share. Michael gave, yes. Are you just giving me a hands up or are you going to question? Okay, great.
Oh, I had a question.
Yeah.
This kind of goes back to the pre-approval screen from before, but so you have to have a pre-approval, but even before you go out to look at homes?
Mm-hmm. It is highly
Okay.
recommended. It is highly recommended. You may be looking online and not working with a realtor. If you're looking online, you can still do that clearly. If you literally are interested in going to see a home with a realtor, it is highly recommended by myself, mostly from a lender, and most realtors would require you to have one. They don't want you to be wasting your time or their time going out looking at houses maybe that are say $300,000 and you only qualify for 200,000. It would waste everybody's time. So again, it's highly recommended, and especially depending on, your realtor, but majority of the ones that I work with do require that.
Okay.
And that's something I can help you with. And it's a quick process. Literally, I have all my information at the end of this presentation. It's a very quick process. It's me getting your personal information. I will also discuss that I have an app that you can fill out your personal information in. I could run that soft credit report within seconds. And then you can upload your income documents and your bank statements literally by clicking on the app and scanning your information. I can do my evaluation and give you a call back, usually that same day.
Okay.
Okay. Anyone else? Questions? Nope. Okay. We'll move on. Next screen. Or next slide, sorry. Okay, so here's an example of an estimated payments in cash that you would need for closing. So to the left, I gave the example of that Miciuda program, since it's one of my top sold programs. At the $224,500 purchase price, conventional down payment is 3%. So that, Jake, are you raising your hand for a question? Nope. Okay. And loan amount would come to then $217,765. Miciuda also has very, very attractive interest rates. Their interest rate today is 6.625. They do not change their interest rates on a daily basis and follow the market rates today. It's unique to Miciuda. It's a great rate. It is under all of the rates today. Trust me, I have clients who want the Miciuda rate, but they maybe don't qualify because of the purchase price or their income limits are too high. But that interest rate of 6.625, they very rarely change it unless the market has a major shift one way or the other. Hopefully in the near future, it'll be shifting downwards, and that will reduce that interest rate. This is probably the longest I've ever seen the Miciuda rate be at keeping the same, and it's probably been this way for a good year and a half, because the market's been where it's been. So what it calculates to is your principal and interest then would be about $1,394, and I have estimated taxes at $285 a month, estimated homeowners insurance at $85 a month, and then estimated mortgage insurance of $183 a month. So for a total monthly payment of about $1,950 a month. So what that does is, I want to go back to the mortgage insurance. If everybody doesn't understand or know or ever heard the terminology mortgage insurance, every loan, every mortgage will pay mortgage insurance unless you put a 20% down payment. So basically what this is it's a guarantee or an insurance to the lender, to the banks, that just because you're only putting 3% down, they have an additional cushion, if you will, of mortgage insurance. Mortgage insurance is paid monthly. Once you get to that 80% equity, it can be dropped, and that's through a process through the lender, making a phone call directly to them and working out that process. But eventually, when you have gained that equity in your home by making your payments or your values going up, mortgage insurance can be removed down the road. It's derived from the down payment, the 3%, and then it also makes a difference of what your credit score is. So again, circling back to credit score, it's very important to have your score higher, not shooting for, hey, the program is only a 620 minimum or a 580. Let's shoot for as high as you can, because that will better your scenario for a lot of things, especially in the mortgage insurance world. So for the Miciuda loan, let's just say from costs, your closing costs, your down payment, all funds to close come out to be about $18,000 with everything included. And again, I'll give you a different breakdown. Minus the $10,000 you get from Miciuda, your requirement of funds to close would only be $8,800. at this purchase price because you're getting that 10,000 from Miciuda. However, that 8,000 also can be gifted from a relative. Some of that could be picked up. There's what's called seller concessions. Sometimes sellers, the agents can work with the sellers to pay for part of your costs. So they can pay 3%, 6%, depending on the program, but that's allowable as well. So you truly, I had a recent buyer who literally only had to come into closing with a total of 1% of his own funds because seller picked up the remainder and he paid the 1% difference. So it can be done. That's just part of the negotiation process though with the realtor. So I didn't add those, but it is a possibility that you would have to come in with much less. A screen that I didn't put in here is a breakdown of all the costs that go into the loan besides just your down payment. So you have the down payment of the $6,700, but there's something that's called escrow account. That what that is that we are creating an account as a lender for you to pay all of your future taxes and insurance. So that is additional funds needed at closing. So this is where that 18,000 comes in at. There's other items on that cost, and they're true costs to do the transaction. They're not just Mortgage One or myself costs. There's a lot of other, to do your appraisal, to do an inspection, to pull your credit report eventually, the hard pull. All of those things in a title company. Title companies do your actual closing. There's title insurance. So all of these things are wrapped into this amount. So the total might look alarming to you, but it truly is specific to the fees, the cost to have a mortgage loan. And then to the right, I did an example of just an FHA loan. I just wanted to do apples to apples for a purchase price the same of $224,500. But for FHA, if you remember on the previous screen, they have a requirement of 3.5% down, which bumps your down payment up a little bit. Then your loan amount would be $216,600. Interest rates on FHA are a little bit higher than Miciuda, still very attractive, but not as low as Miciuda. So again, principal and interest, $1,441, estimated taxes and insurance are the same. But when you go down to mortgage insurance, if you notice, there's a huge difference between FHA and a conventional loan. Why that is FHA chose to charge only a straight percentage of mortgage insurance to your loan amount versus based on your credit and your credit score and the down payment amount. So it is strictly a 55% percentage to mortgage insurance that you have to pay. So FHA is much cheaper. However, if you do the apples to apples, you can see that the payment comes out to almost the same as the Miciuda. So the total funds to close for an FHA loan with all those fees, all that all the costs, everything included, is about $20,000. Their FHA does have a couple more inspections that they include, but at this point, you're not getting any assistance from Miciuda of $10,000. This is straight up, funds that you would need, or the seller, or a gift. But just to give you an idea with numbers, $224,500 could be, a high purchase price from what you guys are looking for. Maybe it's a low purchase price than what you're looking for. I can run all of those payment scenarios for you again when we talk through, getting your credit, running a pre-approval, and going through all those numbers on my app as well, which I'll have, ask you all to download if you move forward and want that pre-approval. You can also plug in numbers on the app directly, and that will give you an idea of payments. You can change it from 3% down to 20% down. You can put taxes at $285 or $485. So it's a really good tool that I have to help calculate those payments when you're, curious on what it would be. Any questions? I know it's a lot of information, but any questions? Jake, do you have a question? You want to unmute maybe? Or are you just waving? Raising your hand. Go ahead, I'll call on you though, Jake. Brendan, do you have a question?
Yeah. Hi again. Um, I just have a question about the interest rates for
Uh-huh,
a Miciuda or a FHA.
uh-huh.
Like if you were to like at the time of your purchase, your interest rate is 6.625. And then like Miciuda changes their interest rate. Does your interest rate change, or is it locked in at that number?
That's a great question. So when you are looking and you find an actual property, you made an offer and the offer was accepted, once that happens, Mishta does lock in that interest rate where it is as of that day. So if they still are 6.625, you will be locked into it. If it did go down or up during your application process, you are locked into the 6.625. We cannot relock you lower, just as well as we will not relock you higher. Now that is for
Okay.
Mishta. Yeah, you're welcome. That is for Mishta. So they changed theirs all as a whole, as a program. FHA conventional rates for all the other programs that were listed, I personally would be the one locking in that interest rate. So that is based on today's market, what's going on, if it's trending down, trending up. Sometimes rates change once a day, sometimes they change once a month. It all depends on what's going on in the economy and the major factors that move the actual mortgage interest rates. So say this was, for example, the FHA rate, which I should have put a clause in there, that was the FHA interest rate as of yesterday. Today, I got a notification that they were getting slightly better. So today, if I pulled it back up, it could be 6.99. It's just you don't know until, closer till, but it's something that I watch with you, and I can lead you to the right direction on locking in the interest rate. So that's a great, great question.
Okay.
Do you have another one, Brendan?
Right now, no. Sorry.
Okay, that's okay. I'm sorry, I'm looking at the people raising their hands. So, okay, we're going to go move on to the actual high level home buying process. You typically start with getting that pre-approval, as we mentioned, but you also may be already in discussions with the real estate professional. You would want them to, again, have a pre-approval in conjunction with starting to go look at homes. So if you're out there right now kind of surfing online, which most people do because there's a ton of apps or websites available that you can see what's listed on Zillow and realtor.com, all of these websites that you see when houses. And there's so many different advantages though to utilize a real estate professional though when you're really ready to make like an offer and put something down on that house, put an offer down on a house you like, because these professionals like myself, they're in it every day. So they know some homes that they might be listing. Somebody in their office might be having one coming listing. Their friend down the street at their competitor office might know somebody that's listing. Maybe their friend's going to list the house. So there's a lot of advantages of utilizing, obviously, a real estate agent. You need to do your research with, those as well as, myself, a lender. There's a lot of wonderful local realtors. I have a handful of referral sources of realtors that I work with on a daily basis. So if you don't have, anybody, I can certainly make a referral, or so can Kathleen, and maybe, family, friends, whomever, to be asking around. But after you get pre-approved, work with your agent. You're basically searching for homes with them. They're going to set you on automatic listings to your email. You may say, yes, I want to see A, B, and C. You make an appointment with them, or they make the appointment for you. You go out and look at the house. Then you want to make an offer. You go under contract. You go into negotiations. If it gets accepted, doesn't get accepted, and then you move on to finalizing your documents for closing. And then after that, yay, congratulations, you're a new homeowner. Not that simple, but there's some things in between. But to give you a high level for the overall process, a little roadmap here. Any questions? I know I think we might be coming close to time. We got 5 more minutes here. Any questions right now? I think the next screen really is just my contact information. And as you can see there, I do have an app. It's called ProSnap. You can go into your Play Store and download the app. It is Mortgage One. It's a secured application. almost 90% of my clients use it. Ones that maybe it's not overly tech, you don't have to be tech savvy to use it. It is pretty user friendly. You can scan the QR code to get to it. You can email me, we can talk further, my cell phone number. I can give you additional information, answer more questions you have, but I appreciate you all being here today.